Yep, here we go. Oh, hello, everybody. This is the fourth episode of the Douglas Social Credit Podcast. My name is William Waite. I'm here again with Oliver Heydorn. And today we're going to be discussing the topic of usury and specifically the Douglas Social Credit perspective on usury. So I was thinking, Oliver, you might provide us with a definition, and we can probably go from there.
Right. So usury is one of those terms that has been defined in 101 different ways. Some people define it simply as the charging of interest on a loan, right? Any kind of interest, any rate of interest is considered ipso facto usurious. I would say that a more accurate definition would be to define usury as economic rent taking in banking. So
Mm,
whenever, well, it's not only in banking, but anytime that anyone makes a loan. So whenever a person makes, let's say, an unearned profit through the lending of money, that type of profit making could be defined as usurious. Right? So banks obviously have expenses, they have costs in order to provide the services that they do provide to the community. And it's quite legitimate for them in one way or another to charge to cover those costs, because if they don't charge to cover those costs, the borrowers would actually be taking advantage of the lenders. The lenders would be lending at a loss, and obviously they wouldn't be able to sustain that forever, and they would go out of business. So it's one thing to charge a certain amount of money to cover your legitimate costs, whether those fees are levied in the form of a service fee or charging a certain rate of interest is, in my view, not so important, because
mm,
if you say you insist on service fees, well, if a bank is going to charge $1,000 to cover the administrative costs of a particular loan, let's say, you can, as an alternative, charge a certain rate of interest that would, equate to $1,000. So you can convert them one to another. It's. I don't think people should get too hung up on whether it's an interest charge or a service fee. I do grant that a service fee is psychologically more palatable for a lot of people because it
mm.
emphasizes the fact that you're not charging for the money that's been created out of nothing. You're charging for the actual service that the bank is providing. But in theory anyway, you could arrange it so that the amount of money that is owed is the same amount, whether it's done through an interest charge or a service fee. So the critical thing, I think, when it comes to usury is, uh, what profit would banks be making in a perfectly competitive market versus the type of profits they make in oligopoly or monopoly markets. And one of the very interesting things about banks, and we're going on the official numbers. Undoubtedly, banks also have all sorts of stratagems and means of minimizing, or hiding some of the money that
Mm.
they make, so it's not to scandalize people too much. But very often, profit margins in banks are very, very large, very significant in comparison with other industries: 10%, 15%, 20%, 25%. And in Canada and in Australia, the major banks make billions of dollars in profit through their activities.
Mm.
And that, insofar as that deviates from what they would be making if the market in bank credit was perfectly competitive, you might regard that as monopoly profits, oligopoly profits, uh, unjustified profits, economic rent taking, basically, in the lending of money. And that is usurious. We would all prefer to have that money in our own pockets and not have to hand it over in order to obtain a money supply. So if you have a situation where we're paying excessive amounts of money to rent the money supply from the banking system. Uh, that I think is what usury really is. Maybe
I
you've got
think it's
something to add.
important to I think it's important to emphasize the position of banks as well, because most people don't understand that the money that banks loan is actually not previously their money or anyone else's money. And in fact, the money that they loan doesn't exist prior to the drawing up of the signing of the loan contract. So the position of banks is one of creators of the money supply. And every economy, every money economy requires a reliable money supply. And it just so happens that this private, and in Australia, it's openly referred to as a monopoly. Like all the big banks move as one. The providers of the money supply are actually, a private monopoly functioning in its own interests. And this is obvious, especially when banks are booking massive profits, even when the economy isn't doing very well. It's as though the banks have the power to work against the interests of the community. When there's a cost of living crisis, the banks have these, are recording these massive profits. So I think it's important to emphasize that, like banks get away with what they do largely because there's kind of well, maybe because we don't have the levers to change it, but also because there's widespread misconception in the community about the position of banks. Their profitability hasn't so much to do with the service they provide as much as it does, as I see it, with the position that they occupy in the economy. That is the position of creators of the money supply.
Yes. Yeah. So we want to stress then that, as far as Douglas social credit is concerned, economic rent taking in the case of banking is a problem because it's one of the main mechanisms by means of which wealth, privilege, and power is centralized.
Mm.
So you have, as you're describing, a situation where the banking system is in a position to take advantage of the other, the rest of the community, other sectors in the community for its own benefit at
Mm.
the expense of common good. And that's very problematic. And the wealth and power that they gain through the centralizing effect of an usurious money system is one of the factors that keeps the system in place, because they're quite happy, obviously, to benefit in this way, and they would not want to change the system to one in which they were no longer in a position to earn such excessive unearned profits. They don't want to give up the economic rent taking. If
Mm.
we had a Douglas social credit system and you broke the monopoly of credit, you had a national credit office that created compensatory consumer credits, debt-free in the form of a national dividend and a national discount, that would significantly impact the amount of money that banks would be called on to create and lend. And therefore, it would also automatically reduce the usurious nature of the existing system. They wouldn't be able to charge or earn as much money if you had a social credit system in place.
So there, Oliver,
Go ahead.
we're about to be cut off. I'm just being told now.
Okay, how much time do we have?
Less than 1 minute.
Oh, okay. So
So I
we'll
thought
stop.
the social credit system in place, you could cut it there and
Yep,
then
we'll
go
pick
from
up.
there.
All right, I
So
will
apparently
send
you
you
get 45 minutes, not an hour.
45 minutes. Okay. All right, I will send you a link and we'll continue. Yeah, so another closely connected point that I want to make, it's a point of clarification. It's quite important, actually, is that some people have the erroneous belief, and even some of them are social creditors, if you can believe that, that the problem with the existing financial system is usury. It's what generates the gap between prices and incomes. And then so all we need to do to fix the system is get rid of usury, and that would fix the problem. So this is incorrect. According to C.H. Douglas, yes, banks charge more money than they simultaneously distribute to the consuming public, but in that they are not unique. All businesses do that.
Mm.
And in addition to that, the A plus B factor, which we'll talk about probably in some future episode, which is the main cause between or the main cause behind the chronic lack of consumer buying power, this discrepancy between the rate of flow of prices versus the rate of flow of income distribution. That has nothing to do with usury as such. That has to do with cost accountancy, particularly cost accountancy involving real capital. So machines, equipment, other things of that nature, they have to be manufactured, they have to be purchased, they have to be depreciated, they have to be maintained. And so businesses end up charging more money from the consuming public than they distribute to the public. And that combined with the reinvestment of savings, profit making itself, and deflationary bank policies, all these factors can help to generate the gap. So usury is not the main problem. It's not the main gap producing factor. And therefore, getting rid of it is not going to solve the problem. If the banks didn't charge any interest, or they only charged service fees and it was just sufficient to cover their costs, there would still be a significant gap between the rate at which prices are being generated in the economy and the rate at which incomes are being distributed. And therefore, there's still the opportunity to fill that gap with compensatory debt-free credit in the form of dividends and discounts.
I suppose you could say that interest charges contribute to the gap,
Mm-hmm.
in that they are a price incurred by business, or incurred by nearly everyone, really, and they do contribute to the gap, but they're not the cause of it. So, what would you say to people who say that when people borrow money, the amount that is borrowed is generated, as the principal of the loan, but then they're required to, because I think this is where the misconception arises, but then they're required to actually find the interest charges which are not created when the loan is created.
Right.
So this creates kind of a self-perpetuating debt cycle. What would you say to that argument?
Yeah, so this is sometimes referred to as the debt virus hypothesis. We would say that it's the effect of that is not as great as people think, and it's not in any way unique. The problem is that when people think in this way, they do not take into consideration the fact that the banks are also spending money into the economy. So they buy, sites, they put up buildings, they have utilities to pay for, they have employees that they have to provide wages and salaries for. So the banks are already expanding both sides of their balance sheet and using some of that money to fund their own operations. And so they're injecting money, which they then recuperate in the service fees and the interests that they charge. So as far as costs are concerned, operational costs, there's already going to be some degree of balance there because they are distributing income to consumers. Not sufficient to cover all their costs, but in that they're not unique. All businesses are in the same boat. Now, it's true that, as we were talking before about economic rent taking, it's true that insofar as the banks are profiting disproportionately, it's an exploitative type of arrangement too, because everyone needs bank credit. That's going to that excessive profit making is going to contribute to a gap, but in that there's nothing specifically unique about banking. Any company that is engaged in economic rent taking would be doing the same thing and contributing to the gap in the same way. So I guess the bottom line is that banking is really not singular or not fundamentally unique, because the banks are also spending money into the economy, and that helps to balance to some extent the amount of money that they're then charging.
I would just say, though, that again, just reiterate that the banking system occupies this very special position
Mm,
because, it seems to function as a monopoly. It does function as a monopoly, and everybody at every level of society needs its product.
mhm.
So it just seems like the interest rate, if you like, is very wide. I mean, everybody who takes a business loan, for instance, is paying the bank 10%. Everybody who takes a mortgage is paying the banks. Like, there's no other business which has such a wide cast, such a wide net,
Mm,
if you
mm.
see what I mean. I mean, even the governments are beholden
Yeah.
and to pay the interest rates asked of banks. And it just seems like this, in and of itself, is quite a powerful method for the centralization of control of financial
Yes.
resources.
Yeah. So one of the things we might mention in connection with just the charging of interest and sort of interest rate structures as well is that very often the way that it's set up, the banks are not really sharing the risk of their lenders in perhaps the way that they should if we had like an equitable balanced arrangement as our ideal. And in this, they may differ from other businesses. So, there's the statement has often been made that even when the economy isn't doing so well, nevertheless, the banks will get their money first and they'll be fine, right? They're securing their own well-being and not really sharing in an equitable way with, in the risks of the people that are borrowing. Now, if you're gonna lend money, I think something does need to be changed there structurally. If you're going to lend money, perhaps you should only make a profit if the productive organization to which you're lending money is making a profit. And
Mm.
that, if they don't make a profit, well, maybe you're only entitled to cover your costs then. But it seems
Mm.
that the banks insist, no, we're going to make a profit regardless of whether whether the people we're lending money to are profitable.
Well,
And that,
how would you even calculate the costs of banks? I mean,
mm,
if you consider that banks don't actually, like, the money that they lend, they
mm,
just get for nothing. How do you calculate the costs of a business like that? Because
mm,
even like the principle of a loan, is that a cost to a bank in the same way that a guy who loses his house is a cost to that guy? Like, the risks are not, they're not.
commensurate.
You can't compare them. Yeah.
Yeah, I would agree with that. I mean, banks do they are concerned about bad loans because, of course, that has an effect on the balance sheet, and so they are trying to cover themselves in various ways. Uh, but certainly, I think you're right. I think the cost, the real world cost to the borrower and the real world cost to the bank is not exactly the same or commensurate.
No, that's right.
Yeah. So one of the points that Douglas makes is that we don't have a problem with private banks. In fact, we think there should be even more banks than there are, and
Mm.
because that would ensure sufficient competition where you could have like a perfectly competitive market in bank credit. And we also don't have a problem with banks making a profit. However, Douglas says that the policy of the bank should be to serve the well-being of the community, to serve the common good, and that they shouldn't be cornering the market in bank credit and running their business as if they don't have to think about other people's businesses, because all of our business depends on the banking business. So there's a social function that they have to fulfill, that they need to fulfill, and that needs to come first. And they should be rewarded as private organizations. They should be rewarded with profit to the extent that they're serving that common good. And therefore, a national monetary policy needs to be imposed by the state on the private banking system in order to ensure that the financial system, the banking system, is fulfilling its true purpose in an effective, efficient, and fair manner. And so you ought not to treat banking as just being the same as any other business for that reason.
No. Well, where is the consideration for the well-being of the community? Say, if we've got various bubbles in the economy at the moment, for instance, the real estate bubble.
Mm-hmm.
So if that pops and economic chaos ensues, where's the well-being of the community in large-scale defaults and throwing people out of their homes?
Mm.
But that is certainly within the power of the banking to do, and that is what happened in America.
Mm-hmm.
In the wake of the GFC.
Right.
Should private citizens be somehow protected from that sort of behavior of banks?
Right. And there was.
I don't know what form that would take.
Yep.
But
well, I mean, we anticipate if we had a Douglas social credit system in place, this would stabilize the economic and financial systems, and therefore a lot of these things wouldn't be a problem anymore.
Yeah.
But
in terms of running up, in terms of asset bubbles and things like this.
That's right.
I mean, the whole idea would be to achieve an equilibrium.
Right. That's right.
So exactly, yeah, you wouldn't have this kind of volatile system where you haven't got enough money in the system, and then you pump money in and she goes too high, and then prices take off, and then you try and claw it back.
Yeah. So I think it's important to understand that while we're not against profit, the whole orientation has to change. That yes, banks, they fulfill a function. If they fulfill that function well, then they should make a profit on that basis. Not the situation sort of the setup we have at present, which is they're going to make a profit. They're going to seek their own interests, and they're allowed to make a profit regardless of how well they are fulfilling the true purpose of the financial system. So we need to bring those things into alignment, that they are rewarded to the extent that they're actually doing what they should be doing and fulfilling the function that they should be fulfilling in society. And if we do that, then again, a lot of the concern about usury is going to fall away. I should mention, just on a personal note, that because it's always a bit difficult to present these things in a way that it's sufficiently balanced from all sides. Yes, usury is a problem. In fact, that was my gateway into the Douglas social credit world, because about 20 years ago, I had $25,000 in student debt. I learned that the banks actually create the money that they lend out of nothing, that they're not lending other people's money that they've worked for and have deposited with them. It's just a matter of accounting entries. And had I paid that loan back according to the schedule that the bank wanted to impose, I was going to end up paying something like $8,000 in interest, which seems paltry in comparison with what some people pay on mortgages or student loans these days. But nevertheless, it seemed ridiculous to me. I mean, I obviously can't create the $8,000 or the $25,000 to pay back the principal. So for me, it took a while. I was just getting started in my work as a philosophy professor, as an adjunct, which adjuncts don't get paid that much. And it was going to take a while for me to acquire the 25,000 plus the 8,000 to pay them back. I couldn't do it simply by an act of fiat. So that seemed inequitable to me because I thought, well, have they done $8,000 worth of work? Right.
Yeah.
And this is one of the problems with the charging of interest or the interest system is it doesn't seem to map on to what the expenses the banks have actually incurred in providing this or that service. So in my case, how much did it really cost them to create this money, 25,000 out of nothing, lend it to me over a period of maybe it was 5, 6 years and administer that loan? I mean, how much was that my particular thing actually costing them? Certainly not $8,000 worth, right?
Mm.
So at what
This is
point?
what I mean by
Mm,
that they're leveraging their position. It's not the value of the service they're providing.
mm,
There's this indispensable position there, and they occupy it, and they're just happy to just rip the ring out of it.
right. So they'll charge whatever the market will bear, as they say. But
Well,
we're all
exactly, and the market will bear a hell of a lot because the product they provide is absolutely essential.
right. And we can't get it by any other means, right? So it's we're in a situation of
Yeah,
dependence. Yeah.
yeah, that's right. That's
Right.
right.
So
And there's no competition in the sector.
no.
Like I've wondered, um, what difference would it make if the and I'm not suggesting this. People say, oh, I don't want to nationalize the banks, but even if the state opened a new bank and said, right, people buying their first residence, they'll never pay more than 2.5% interest if
Mm,
they take the loan with us. Like that would be sufficient to cover the costs of the service. And I think that with all this technology, banking services must be getting increasingly automated. They're shutting down branches everywhere. They're, they're limiting the amount of cash handling that they do. So I
mhm.
think their costs must be coming down.
Yes.
Banking costs must be coming down. But if there was, my point is, if there was actually, an element of proper competition, how would that change the situation? I mean, everyone with a mortgage would. Oh, and then they say, oh, then you could say, oh, and it costs nothing to transfer your mortgage over here. Well,
Mhm.
suddenly you have introduced, a real. There's an element of competition there where there wasn't before.
Right.
So,
Yes, and there are other things we could talk about too that further complicate things, but complicate things in favor of the bank's interest. So, typically the interest they charge, it's compound interest, it's not simple interest. If you look at mortgages, you're paying most of the interest up front, and it's only in the later stages of the mortgage that you're actually paying down the principal. So there are all these ways in which it's like a casino. It's all geared in favor of the house, and
yes,
uh,
yes.
and so the business is really a racket, really.
It is, yeah.
And that's terrible and awful, and it is a huge problem because it means that the people who have the power to change the system aren't going to want to change the system because they benefit so heavily from the existing system. And it has major implications in terms of the centralization of political power even in the world. And so it's not an insignificant issue. However, it is not the only problem that we face, and it's actually arguably not the root problem, because the root problem is the fact that the financial system as a whole doesn't accurately reflect reality. And the problem that Douglas identified as a technical problem, dealing with the fact that the existing system does not automatically distribute sufficient income to balance the flow of costs and prices in any productive undertaking. Now, that affords banking its opportunity to fill the gap.
Mm.
Of course, it will only fill the gap on terms that further its own interests at the expense of the common good. And so they're
Mm.
deeply intertwined. I don't want to downplay that aspect of it, but it's the major problem is technical, and we need to keep
Sure.
those two things separate in our minds.
I mean, I think the pendulum has swung a little too, or quite a ways too far in favor of banking as a private profit making business. I
Mm.
mean, it needs to come back more in the direction of banking being like a public utility,
Hmm.
like something that the community needs. It needs to be, it needs to be accountable and it needs to be overseen
Hmm.
by some public authority. Um, because of the position which it occupies, the importance of that position, and the importance of getting the settings right.
Yes, I agree with that. The only thing I might add, though, is that the danger that we face, I think, at present with what's going on with the private banking system, and you're quite right, it's gone to an extreme, especially, I suppose, under the influence of neoliberalism and neoliberal policies, is that should there be another financial crisis, the real powers that be, may be setting up a situation where uh, private banking becomes totally discredited, and then we'll
Mm.
replace one monopoly with another monopoly. That monopoly will be quote unquote public, but it won't be the state operating in favor of the common good. It will be the state operating in favor of hidden oligarchic powers. And
Sure.
so, we need to have this balance between public and private and ensure that we don't replace one monopoly with another monopoly. And
Mm.
that's sort of the danger, is that you could have a reaction in the direction of quote unquote public, but it's not the real common good that would be the object of the public.
What was that?
I have no idea. They're balloons floating on the screen. All
You
right.
don't have anything else to add?
I don't think so. So I think it's just important that people consider um, that's with the dialectic, sometimes things are pushed very hard in a certain direction so that the people that are running the dialect can then harness the reaction and go in a direction that we don't want to go either.
Yeah, sure. Yeah. Well, we were talking earlier about, the idea that Richard Werner promotes to have, lots of local private community banks,
Mm.
embedded in the communities that they serve and financing projects and people in the interest of that community. I think as far as banks go, that's probably a pretty good model.
That's right. We want the decentralization of power. That's
Yes,
what Werner
exactly.
says. That's what Hilaire Belloc and Chesterton say. It's what Douglas Social Credit says. We have to find ways of moving in the opposite direction to both public and private monopolies. So we want
Mm.
centralization. The public, the state has a role to play, and private companies also have a role to play. But the policies that these entities serve has got to be the common good, the decentralization of power in favor of the individual, and that's the bottom line. Yeah. All right. So I guess we'll end there, and we will join you next week with another episode. Please like and subscribe. Our websites will.
Socrad.org and thepeoplescredit.com.au. Lots of stuff there. See you next time.
All right. Bye bye.